Imagine you're handed two projects. One costs more upfront but pays off steadily. The other is cheaper, but its returns come later and are uneven. Both sound promising. The problem is that none of the cash flows line up in time, and none of them happen today. So here's the question this video will answer. How do you objectively decide which project is actually worth more right now, before you spend a single dollar? The answer is present worth analysis. Present worth analysis, also called net present worth or net present value, is one of the most fundamental tools in engineering economy because it allows us to compare cash flows that occur at different times by converting them into a single common basis. That common basis is time zero, which simply means today. When we say that present worth expresses an entire stream of cash flows as a single equivalent amount at time zero, what we are really saying is this. Instead of juggling money that arrives in different years, we ask how much all of that future money would be worth if it were given to us right now. This idea reflects the concept of the time value of money, which you can learn more about in the linked video. Once all cash flows are converted to their equivalent value at time zero using the minimum attractive rate of return, or MARR, they can be added together into a single number called the present worth. That number answers the question posed at the beginning of the video. It tells us, in today's dollars, whether a project creates value, destroys value, or merely breaks even relative to the firm's required return. From this point forward, the entire analysis follows a consistent logic. For a single investment, if the present worth is positive, the project is economically attractive and should be accepted. If the present worth is negative, it fails to meet the firm's minimum requirements and should be rejected. For multiple mutually exclusive alternatives, the preferred option is the one with the greatest present worth over the planning horizon. No matter how complex the cash flow pattern appears, present worth allows us to reduce the decision to a comparison at a single point in time, today. To see how this works in practice, consider the following example. A manager is considering buying a machine for $500,000. It saves $92,500 per year in operating costs and will be worth $50,000 after 10 years. Based on the firm's 10% after-tax MARR and a present worth analysis, should the investment be made? The initial cost is already at time zero, so it enters the present worth equation as negative $500,000. The annual savings form a uniform series, which we discount to the present using the present worth of an annuity factor. The salvage value occurs at the end of year 10, so it is discounted using the present worth of a single future amount. Substituting these values into the present worth equation yields a present worth of approximately $87,000. Because this value is positive, the investment exceeds the firm's minimum attractive rate of return and is therefore recommended. The same result can be obtained using Excel by applying the PV function with the MARR, number of periods, annual savings, initial investment, and salvage value. Minor differences due to rounding may appear, but the economic conclusion remains the same. Although the final present worth is positive, it is important to understand how the investment behaves over time. If we compute the cumulative present worth year by year, we see that the project initially loses value and remains negative for the first 8 years. It is only in the 9th year that the cumulative present worth becomes positive. This observation highlights an important economic insight. If the project were abandoned early, its profitability would depend heavily on the salvage value at that point in time. This idea becomes especially relevant when discussing discounted payback period and project risk. Present worth analysis becomes even more powerful when it is used as a ranking method to choose among multiple mutually exclusive alternatives. In this case, the decision rule is to select the alternative with the greatest present worth over the planning horizon. The do-nothing alternative is always available and has a present worth of 0, which provides a useful baseline for comparison. To illustrate this, consider two alternative machine designs. The first design requires an initial investment of $300,000 and is expected to generate annual after-tax revenue of $55,000 over a 10-year life. The second design requires a larger initial investment of $450,000, but is expected to generate annual after-tax revenue of $80,000 over the same 10-year period. Both alternatives have negligible salvage values, and the MARR is 10%. For each alternative, we compute the present worth by discounting the uniform annual revenues and subtracting the initial investment. For the first design, the present worth is found by multiplying the annual revenue by the 10-year P/A factor at 10%, and then subtracting the initial cost. This results in a present worth of approximately $38,000. For the second design, the same process is followed, but with a higher annual revenue and a higher initial cost. The resulting present worth is approximately $42,000. Both alternatives have positive present worths, meaning that each is preferable to doing nothing. However, because the second design has the greater present worth, it is the economically preferred option. Excel confirms this ranking using the PV function. This example also illustrates that an alternative with a higher initial cost is not necessarily worse. What matters is the balance between cost, revenue, and the discount rate. An important extension of this analysis is to examine how the ranking changes as the MARR varies. In this example, the more expensive alternative has the greater present worth at lower discount rates. But beyond a certain MARR, the simpler design becomes preferable. At sufficiently high MARR values, neither alternative is economically attractive. This sensitivity to the discount rate reinforces the importance of selecting an appropriate MARR. Finally, present worth analysis can be applied to one-shot investments, which are opportunities that are available only once and cannot be repeated in the future. When comparing one-shot investments with different durations, the planning horizon is set equal to the longest life among the alternatives, and zero cash flows are assumed where necessary to equalize the time frame. The MARR captures the opportunity to reinvest recovered capital. In the final example, two one-shot investments with different cash flow patterns and different durations are evaluated using a 6-year planning horizon and a MARR of 15%. Each alternative's cash flows are discounted to time zero using present worth factors, and the total present worth is computed. The first alternative yields a present worth of approximately $6,564, while the second yields a present worth of approximately $6,721. Excel's NPV function confirms these results. Because the second alternative has the greater present worth, it is the preferred investment. This example reinforces the core principle of present worth analysis. Regardless of the complexity of the cash flow pattern, all economically sound decisions can be reduced to a comparison of equivalent values at time zero. So if there's one idea to take away from this video, it's this. No matter how complicated a project's cash flows appear, present worth allows you to reduce the decision to a single, defensible comparison made in today's dollars. By anchoring every analysis at time zero and using the MARR to reflect opportunity cost, present worth gives you a consistent framework for evaluating investments, ranking alternatives, and understanding risk. If you found this breakdown helpful, consider subscribing for more engineering economy explanations. You can also learn more ways to compare investments by checking out the linked playlists. Thanks for watching, and I'll see you in the next video.